Hey, what's going on, everyone? Thanks for joining me this week in the Southwest Florida housing market. We've got some major changes that have been happening, not only in just the economy, but also our local markets stats. So this week I'm coming to you live. So you're going to get all the raw footage. And I have a lot of big news that has really started to hit our market quite heavily. And you're going to see all the changes where it looks like the market has possibly started to flip. So that's all coming up in today's episode, so stay right here. All right, so this week, there have been quite a few changes. You're going to see those coming up, and definitely the market stats that we're going to be doing right here live, and then also the stories I'm going to be pulling right from the actual news articles online this week. So you can see the sources, and if you want to go and dive into the articles more in depth, you can see that. I will have the links as well in the description below. So let's get started right away with the 7-day market update. So this is week over week, and I'm going to actually get rid of myself here so I'm not in the way. But this is week over week. You have new listings went from 902 last week to 811 this week. That's down 11%. And while the number going down looks pretty bad, just keep in mind, we've been actually increasing inventory every week. So more and more listings have been coming on than have been going off. So even though that's down, you're going to see in our next slide with the inventory breakdown that the actual stats for inventory on the market has been going up. And this week, it was a huge increase. So solds went from 1088 to 801. That's down 27%. Again, same story as last week. The solds, there's less people buying. So less homes are going off the market. And the solds are actually a lagging indicator. So this is all stuff that's happened 30 to 45 days ago. Now, with it going down that much, over 200 plus homes, week over week, that's indicating that we're seeing the effects 30 to 45 days ago. People started to slow down with buying. The leading indicator, though, is the pendings. So they went from 918 to 809. So this is going to be an indicator 30, 45 days from now that the solds are going to be even lower than they are now. And pendings are down 12%. Again, price decreases went from 788 last week to 792. So that's a new high. And just in addition to that, it's really the same trend that we've been seeing every week now for, I think we're going on now 11 or 12 weeks in a row. Moving on to the inventory breakdown. So single families went from 3682 last week to 4033 this week. That's up 351 new single family units on the market right now. So that's a huge increase, and one of the single largest increases for single family homes that I've seen since I've been keeping track of this. Condos went from 1789 to 1921 this week. That's up 132. So we had a net gain of 296 last week, and now we have another net gain on top of that of 483. So this was a huge move this week. Lots of inventory has been coming on the market. We've known that, but this is one of the largest gains that we've seen week over week. Multifamilies also went up quite a bit this week. 143 last week to 166 this week. That's up 23. And if you remember, or if you go back and check into some of my earlier videos this year, around January, February, you'll see that the multifamilies were actually down around 60 to 70. So that was what our average was for almost a year and a half. And then over the last couple months, we've seen an increase. But this week, 166 tops the list. So that's the highest we've seen for multifamilies on the market. Then we went from foreclosures, 43 down to 42. So again, same idea. Not seeing a whole lot of movement in the foreclosures. But again, they take at least 6 months or more for those things to come to market. Interest rates this week, really not too much of a change as far as NerdWallet's concerned. The 30-year went from 5.669 to 5.68, so that's up just a few basis points. And then bank rate at the bottom had the average going from 578 to 5.99, so that's up 21 basis points. But in general, we're hovering right now around the 6% range for the 30-year fixed rates. And we did see, just moving right on to the actual mortgage applications, We did see an increase over the last week, but that was compared to a holiday week where we did see a decrease quite a bit. So mortgage applications actually increased 6.6% from 1 week earlier, and that was including the Memorial Day holiday. But when we break it down, mortgage rates increased for all loan types. So we're seeing a common trend here. Part of this could be because people are racing to get the rates. They're afraid that the rates are going to continue going up and they're going to be priced out for good, with everything that's going on in the economy and all the kind of the fear that's going on. Mortgage rates increased across the board. 30-year fixed rates last week jumped 25 basis points to 5.65%. And then if you also remember me talking about what do you do to keep track of the actual interest rates, you look at the 2-year or the 10-year bond, usually the 2-year though, and the 2-year is going to really indicate where fixed mortgage rates are going, because it's usually about 2.5 to 3% above that. So if you go into any day trader chart and look at the 2-year bond, it'll show you where they're at for the Fed, and then what you would do is just add 2.5 to 3%, and that's going to be approximately what the interest rates are going to be. All you really need to do is see if they're going up or down on that chart, and you'll be able to tell kind of what the where the mortgage rates are going to be heading. As we go down further, despite the increase in rates, application activity rebounded, but remains below pre-holiday levels. So that one holiday week I think is really an outlier. It's just showing that people weren't really looking to get mortgages that week anyways, because they were probably prepping for Memorial Day. But as well as the fact that interest rates have been going up. So while we did see a decline and now a quick increase, I think that's not going to be the story overall. And then as you move down, we look at what the breakdown is. Refinance share of mortgage activity decreased to 31.7% from 32.2%. And then adjustable rate mortgages also decreased 8.1% of total applications. Keep in mind, the more that these application pools shrink, the larger effect these numbers are going to have on each other. So even though it went down a little bit and it's down to 8.1%, what is that as a ratio to the total pool? Is that actually a slight increase as a ratio, or is that actually a decrease? When you look at the FHA, it shows right now on the mortgage interest rates that they're getting out of really out of the realm for a lot of people, because you're seeing that less and less people are putting down 10% or 20% of mortgages. They're putting down now 3.5% with an FHA. FHA share of total applications increased to 11.8% from the week earlier. VAs, which also in a lot of cases don't require anything down, that increased 11.7%, so that's up slightly. And then USDA is the same case, may not actually require any down payment. Depending on your there are some restrictions to it, but increased just slightly as well from the week prior. Let's take a look at some of the stories that I have for you this week, though. That kind of gives you an overall idea of what's going on with the market trends in our local market. Now we're going to move into some of the stories. So just to give you kind of a general consensus, this is from Florida Realtors. The number of buyers backing off may be half. So 50% have put their plans on pause, at least temporarily. Obviously, the 75 basis point hike from the Fed did not, obviously did not help mortgage rates at all. But they believe, Holden Lewis believes that personal finance for NerdWallet, they believe that the interest rates are going to continue climbing. And most of the buyers now have started to opt out, waiting 6 to 12 months before resuming the process. So that's going to affect the market. When it comes to prices in the market, it's all about supply and demand. If there's no demand, the supply, it doesn't matter. Obviously, the more supply, the less demand is going to decrease prices. So if this trend continues, we will probably see, and we are starting to see in some markets, price decreases and equity decreases in homes. Just another Florida story too, for those of you out there who are, will be or are considered hometown heroes right now, which would be nurses, EMT firefighters, law enforcement officers, or educators. Florida just now passed a program $100 million program to provide zero interest loans towards down payment and closing costs, up to 5% of the loan or $25,000. This HHAP loan would reduce the upfront costs for qualifying hometown heroes by providing zero interest loans to help with down payment and closing costs. Obviously, there's limitations to this. The program will be available to more than 50 occupations, and it's obviously subject to certain income and purchase price limits, which vary by county. So if you want to, I will be putting the link in the description to this. It's floridarealtors.com, and you can click right on this 50 occupations to see what the occupation limitations are, as well as this other link, which will take you right to all the stipulations and how the program works. So that's actually some relief for buyers, considering the current conditions and market conditions. Moving on to the next thing, monthly new residential construction. So this is a big story because we've been talking about the builder sentiment decreasing. I think it's down to 67 now, where it was back in January, it was right around 98. So we went from one of the best sentiments that we've ever seen since the sentiments have been tracked to now we're starting to get back into 2006 territory as far as sentiment at 67. But a lot of that has to do with the fact that supply chain issues have been stacking up. And on top of that, the mortgage rates are really putting a dent into home builders. But building permits, we had 1,695,000. Housing starts, 1,000,005, just 1.5, and then housing completions 1.4. So take a look at the chart. The dark green shows the actual completions, and you can see that we've actually been increasing the amount of completions. So we're building faster than we have been in the past. The blue is the starts, which decreased quite significantly, as you can see, over this past month. And that is just the fact that a lot of the builders are getting nervous about maybe this is a bubble, maybe we are overbuilding. As I've mentioned in a couple previous videos, they have started to re-incentivize not only buyers, but real estate agents to help them bring in buyers. There have been some pretty unique and pretty cool incentives for buyers from some of the bigger builders. But this just goes to show you kind of where their head's at. The sentiment's down. They're slowing down on building, and you can see that by the permits being pulled, which is the light blue. That's also decreasing. So builders are slowing down on building, which, we've been hearing this narrative that we've been in, a deficit for so long, and now they're starting to slow down. If that is true, and we are in a housing deficit as far as units, which I'm not fully convinced yet that we are, I think this is going to really have an impact if that is the case. Privately owned housing units authorized by building permits we're at a seasonally adjusted annual rate of 1.695 million. This is 7% below the revised April rate, so that's now down even further. Authorizations in May were at a rate of 1,048,000. This is 5.5% below the revised figure, so that's also down. Housing starts, same story here. That was revised down as well, and then housing completions also. That was actually revised above the April estimate. So that actually went up, housing completion. So that's just showing if that trend continues where we're completing a lot of homes, but we're not starting as many, that could add to the deficit in units if that is the case. Also wanted to take a look at Fannie Mae. This was their projection. They've updated their forecast. Right here at the top, total housing starts, you can see in the first quarter of 2022, we had 1.7 million basically. They're projecting it to decrease quite drastically in quarter two, and then a little bit in quarter two, and then drastically in 3 and 4 of this year. The interesting thing is they only have us losing about 100,000 units from 2021 to 2022. And then from 2022 to 23, we are losing 300,000 units total for starts. And then home sales went there. We had 6.8 million in 2021. Then in 22, we're looking at almost losing a million off of that number. And then they're decreasing another 700,000 into 2023. Personally, I think these are pretty optimistic, these projections, because they also have, if you take a look at the Fannie Mae HPI, we went from in the first quarter 20% year over year. Now in quarter over quarter. And now in the second quarter, they have us going down just a little bit. I think we're going to see that number go down quite a bit in the second quarter here. Also, another reason why I'm a little skeptical of this analysis is the 30-year fixed rate mortgage. They have first quarter 3.8, which we had already started to see at the tail end of that. It was going up into the fives. And they have for the second quarter 5.1. Well, we're already at 6, and we're really just starting the second quarter. So I think that their projections are a little bit optimistic versus what's really going on right now. And I think this is probably going to change quite a bit in the near future. As I mentioned last week, right at the tail end, when I got into the wall of worry, I mentioned that a liquidity crisis, and I just wanted to clarify what I'm talking about a little bit. This article kind of explains it a little bit better, probably than I could. So the next crisis to hit markets may be about liquidity, and kind of going into what is it. So what is a liquidity issue? It is the ease at which an asset can be turned into cash without disrupting the price of that asset. So essentially, it's if you had your money in something, how easy is it to get that money back out? For instance, bonds. A lot of times, if you have a 10-year bond, it's a 10-year maturity period. So you need to keep your money in that for 10 years before you can actually pull it out. So that is a very illiquid asset. Well, what's going on right now in the stock market? These include daily volume, top of book size, how many shares or contracts are on the bid and offer, market depth, what is the total number of shares or contracts below the bid and above the offer. So any trade, there needs to be a buyer and a seller. So if you want to sell your stocks, but there's nobody willing to buy them, you're not gonna sell them. You're gonna be stuck with them. A lot of people are trying to liquidate a lot of their assets because of what's going on in the stock market. And now on top of that, the Fed has begun releasing or winding down their balance sheet. They had $9 trillion on their balance sheet that they've been buying since the beginning of the pandemic. I forgot how many billions of dollars they were spending every month, but it ended up getting up to actually over $9 trillion. So now they're going to be selling that back into the market, and banks will probably be buying that up. But when that happens, it also reduces the amount of liquid cash that's available in the economy. And when that happens, things get tighter and the economy starts to shrink. So declining liquidity can be tied to the Fed's plan to tighten monetary policy by raising interest rates and shrinking its almost $9 trillion balance sheet. The Fed had been pumping $120 billion per month directly into the financial system since the early days of the pandemic by purchasing bonds in the open market. And now that money will be coming out. So this has contributed to higher levels of volatility and has an inverse relationship to liquidity. So as Bloomberg's News Cameron Christ pointed out last week, stock market liquidity is the worst ever outside of the financial crisis and early COVID. So that is kind of what I'm talking about. We're going to start seeing the effects now that the first unwinding has started as of June 15th, so just last week. And I think we're already starting to see that with not only crypto, but the stock market in general. We had another couple negative days last week towards the end of the week, and we'll have to see what the futures hold in tomorrow's market. Also, last, I just wanted to clarify what I've been talking about and just kind of put it in perspective as to what is going on in the economy as far as food shortages and why people think that they will be coming. Last estimate I heard was in August, we'll start seeing the effects of this. And here's a great little graph. It shows you the food prices, which are in light blue, versus the food production. So just like in 2020 when the pandemic started and we shut down everything, production obviously plummeted across the board in just about every industry. Same thing is going on right now, partially because of the economy, but also what's going on in Europe, in Ukraine, all the tensions. So with the production actually going down and prices going up, it's going to make inflation for food a lot higher very quickly. It's just experienced 8.8% increase in food prices. The problem, and there are many, as we've been discussing, is that it doesn't take into account the spiraling costs farmers are now experiencing. So I mentioned this probably a month back. Now that's the farmers are going to be getting squeezed now a little bit with the prices that they're going to have to pay for, the things required. One, diesel's price has gone up, skyrocketed. So it's going to cost more money, not only to ship, but to actually produce, produce the food, because a lot of the machinery runs on diesel. And then on top of that, you also have the surging prices in fertilizers. So fuel and fertilizers right there, you can take a look at these two graphs. Retail prices of food have skyrocketed, as you can see. And then you also have the price of natural gas, which is required for fertilizers, has also increased quite a bit. So those are the big stories. And just to kind of touch on the wall of worry again, Fed tightening on June 15th, that started. We're looking at the liquidity issue, if this is going to become a crisis or not. It looks like it might, and it looks like it's already starting to affect the crypto market. New home builders overstocked and more layoffs. More layoffs have been coming. It seems like every week we're hearing about even more companies, larger companies, laying off quite a number of people. Rolling blackouts this summer, that was in Texas and California, but we'll have to see how bad energy issues get. You also have the China, U.S., Russia tensions. I mean, I haven't heard a whole lot about that too much, as much as I have been recently, but that's something to keep an eye out on as well. And then obviously consumer credit and unemployment. The debt cycle, that's a big issue. If people are spending and racking up credit card debt and then they, get laid off, it doesn't matter, what your situation was, you're probably going to start making some sacrifices in certain areas. And that could include vacation homes, which in Florida, I think it's 1 in 5 homes are vacant, probably due mostly to the fact that a lot of them are secondary homes or vacation homes. So that could potentially bring a wave of inventory to market. So that's what we're really looking for. But if you have any questions, I would love to hear from you guys. I'd love for you to leave some comments. Let me know what's going on in your market. Let me know what you think about these issues. There's a lot of different theories out there on the liquidity crisis, but I hope everybody takes something away from this. And if you have any questions, feel free to reach out to me. All of my contact information is in the link in the description, as well as a ton of free resources for both buyers and sellers looking in this area. So I hope you all stay safe and hope to see you in the next video. All right. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools and resources and hot lists. And if you ever want to connect or just chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.